Welcome into Fireside, a podcast by FS Investments. I'm your host today, Alan Flanagan, an associate on the investment research team. Today, I have the privilege of being joined by Jason Cole, our head of public policy here at FS. And today we're going to discuss, updates on tariffs, trade, and taxes. An update from Washington, D.C., where Jason spends a lot of his time. Thanks for joining us, Jason.
Great to be here, Alan. Thanks for having me.
So we want to level set a little bit. Today is Monday, April 21st, and it's always important to timestamp the dates these days when you're talking tariffs and trade. But there's a lot of activity, a lot of headlines on the topic. And, just to level set, we've got 10% blanket tariffs on all trading partners. There are additional tariffs on certain strategic industries as identified by the administration. And we're currently sitting with a roughly 125% effective tariff rate on China.
145.
145. So obviously eye-popping numbers. We're starting to see some response from trading partners. We're starting to see the administration talk about trading partners coming to the table looking for deals. So that's where, we kind of want to start. Jason, what's the sentiment on tariffs in D.C.? How's it breaking across party lines? Can you just give us the lay of the land of what you're hearing?
Yeah, and I appreciate you timestamping this as April 21st because this has been a rapidly changing topic. Maybe we should timestamp it as 11 a.m. Because things could change even in the next hour, although I don't think that they will. The sentiment in D.C., the good news is Congress is out of session. They were out of session last week. They're out of session this week. And so that's providing a little less feedback coming from Capitol Hill. But prior to leaving for this 2-week Easter recess, as they call it, there was a lot of concern being expressed from the Hill on a bipartisan basis, including from a number of Republicans in the president's own party, publicly beginning to push back a little bit on tariffs. That's the good news if you don't like tariffs. The bad news is there aren't enough of them to really do anything about it. They could do something. There's some questions around the authorities the president used to enact the baseline and the reciprocal tariffs. The invocation of this act, the International Economic Emergency Economic Powers Act, IEEPA, doesn't mention anywhere the word tariff. And there's been a number of lawsuits filed, but there are questions around the president's authority to enact the tariffs in the manner in which he did. There were efforts on the Hill to push back on that, but at the end of the day, those efforts could be vetoed by the president, and there presently aren't 67 votes to override that veto. And so the Hill is, I don't want to say it this bluntly, but I will, is largely irrelevant right now until the numbers increase in terms of the pushback. And I think some of that probably waned on April 9th when the president pulled back a little bit and created the 90-day pause on the reciprocal tariffs, which a lot of members had a lot of concern with.
And it does feel like with the 90-day pause that we're in a little bit of a holding pattern here. Folks are trying to take a longer term view. However you see the stock market volatility as a result. Stock market big sell off post Liberation Day. Big recovery. With the announcement that the initial tariffs would be reduced down to the 10% blanket rate. Stock market doesn't seem to know where it wants to go at this point. I think there's still that skittishness. You still see volatility measures, the VIX, quite elevated relative to history. But it does seem like there's been kind of a coalescing around China really being the focus of the tariff policy. And I think, from an economic point of view, from a, supposedly reindustrialization point of view, that made some sense to economic policymakers and analysts. But, is that kind of a conscious policy course in your mind, Jason, or is that kind of just what happened as a result of how countries responded?
Look, I think the short answer to your question is China has long been a concern and a bipartisan concern in Washington among members of Congress, among this administration. And I think it was always going to be a focus of this administration, of this Congress. But I think the pivot is more likely a consequence around the increasingly escalating tit for tat that the United States and China has found itself in. Right? This started in January, February at 10% on China, then another 10%. And then we went to 34% reciprocal on April 2nd. That invited some retaliation on the part of China. So we said, we'll add another 50. That invited even more retaliation by China. So we added another 41. And now we're 145%. China is at 125% on our goods entering that nation. That has effectively halted all trade between our two nations.
And you're starting to see, non-tariff retaliation as well too from China.
Yes, yeah. They're looking at import and export controls. They're looking at cracking down on antitrust from a number of our tech firms. They're really playing in the services sector where we have strong exports into their country. And so the non-tariff barriers may even be more significant than the 125%. And so there's really a chilling of relationships. And, that has now had a consequence of forcing a dialogue among our administration, our policymakers, with our friends and allies and trading partners around how do you, for lack of a better word, isolate China here. And so it's interesting that the first deals the first countries that have been announced to be seeking deals with the Trump administration are Japan, Vietnam, Cambodia, India, all Southeast Asian, South Korea, all Southeast Asian countries many of whom have had a historically difficult relationship with China and may be on board trying to move this. Though there's evidence to suggest that they might have been moving more towards China. So it will be interesting to see how this plays out over the next 80 days now? 75 days?
The countdown clock's underway.
Yeah, and it'll be interesting to see if that deadline really sticks.
Sure. And obviously these nations stand as the most obvious beneficiaries if there is a rerouting of trade out of China, if there is continued decoupling. But I think, a lot of folks still have optimism that there's a little bit of a de-escalation period or an off-ramp. The level of the tension and the size of the tariffs and the magnitude of the impact of the policy seems unsustainable to many folks. This is why you're seeing, Goldman Sachs and JP Morgan increasing their recession forecasts. It's pervasive across the street, the sentiment that if we stand in the current policy form that, a major slowdown is imminent. So does that seem like, a reasonable perspective that there will be a de-escalation at some point? Or is this really, kind of a standoff at this point, looking for the first to break?
I actually think it's more of the latter, and here's why. Number one, this notion of tariffs, this notion of trade has long been unfair to the United States, is a deeply held belief of this president. It's something he expressed back in the '80s in his book when the Japanese bought Rockefeller Center. That somehow was unfair in the trading relationship. So I think some of these are durable and long-lasting, particularly on the sectoral stuff.
Sure.
Right? The 25% on steel and aluminum, the 25% on autos and auto parts, the soon-to-be-announced pharmaceutical, semiconductor, electronics, lumber, copper. There are ongoing Section 232 and 301 investigations into those sectors that will, I think, result in tariffs at some level, 10 to 25% probably, on all of those products as well. By the way, those authorities are extraordinarily durable. They are written into trade law and allow us to pursue those investigations, and they're extremely durable. And the good news there is there's a process. It's transparent. It takes time. People can see it coming. Unlike sort of the it's April 2nd and 10% across the board and reciprocal on everybody at a formula that basically accounts for our trade deficit with a particular country, which is a little less transparent than the 232-301 process that a lot of these sectoral tariffs are going to enjoin. The sort of the country specific stuff, there may be deals that are done here, and that possibly could get turned off. The curiosity is the 10% baseline, and does that stick? Is that an impediment to deal making? I don't know, and I think part of the problem here is that there's a lot of mixed messaging coming out of the administration. Bessent's on, clearly, from my perspective at least, on a very different page than Commerce Secretary Lutnick or Peter Navarro.
Sure.
And so looking for a signal in the noise here is a little difficult. There may be one. We saw it on the 9th when tariffs were turned off. You talked about equity markets. I actually think, and we've podcasted about this in the past, or at least with Andrew, that back in December and again in January, I said the 10-year may be the final arbiter on policy. And I think we saw indications of that on April 9th, that it was not the equity market per se that forced the reversal on reciprocal with the bond market.
Right.
When you saw a 60 basis point move in literally 24 hours on the 10-year, that I think caused the reversal. And I think if you're an investor out there, I would keep my eye on that rather than equity markets. I get asked a lot when I'm out on the road with investors, is there a Trump put? My answer is generally no, except maybe in the 10-year. Keep an eye on that.
And that's one of the most significant. I mean, the stock market sell-off, valuations were expensive. Absent the tariff headlines, folks, could make a compelling case that the market was due for a little bit of a pullback.
Absolutely.
This is the most concerning element of this, is that long duration trade that's historically kicked in, reliably, consistently for 40 years for investors, just didn't pay off. And in fact, as you said, Jason, 10-year yield sold off the complete opposite way. Invoking investors to really look at their portfolios and say, okay, how am I going to get diversification within this new regime?
And by the way, in an opposite way than I think the administration was maybe expecting. I mean, there's been a long-running dialogue in D.C. When I say long-running, 2 or 2.5 month dialogue in D.C. around the motivation for some of these tariffs. And one theory that had been circulating pretty widely in Washington was that, the early efforts, the sort of on-off nature was almost maybe designed to beat some of the froth out of the market, drive the 10 and the 2 down, and then refinance debt at a lower rate. You saw this on April 7th. The president did a Truth Social post where he claimed credit for for oil prices down, energy prices down, mortgage rates down, inflation, all bold caps. That was the post, down. And within 48 hours, and by the way, that was true on the 7th. The 10-year was sitting at about 399 when that Truth Social post went out and then spiked pretty dramatically. I mean, it literally went parabolic in a matter of 48 hours. And I'm not sure the administration was expecting that reaction.
No, certainly. I think, Bessent is a markets guy. He has a financial background. I'm sure that he was acutely aware of the historical relationship. And, as you said, they've continued to jawbone the 10-year and really have that be a focal point, of their policy around trade and tariffs. So now we're at this point where countries are coming to the table. We hear this out of the administration almost every day. Everybody wants to access our market. Everybody wants to make a deal. What do the deals look like? It would seem to be a very in-depth process, and if handled on a bilateral basis across the board, how do you get that process done within a 90-day window?
I think it's extremely difficult. Remember USMCA that the first Trump administration renegotiated took 13 months. Chorus, the Korean deal, negotiated, I believe, in the Obama administration, took almost 2 years. Japan FTA took almost 2 years. I mean, these things take a very, very long time. The interesting point is that we do already have free trade agreements in place with Canada, Mexico, USMCA, Japan, Vietnam. Some of these nations that are already actively negotiating. There may be an opportunity here to sort of streamline those negotiations around, the president says he wants to get rid of some of these non-tariff trade barriers. Those may be in play in these conversations, because I believe for Vietnam, the tariff rate was almost effectively zero to begin with. And so it's the non-tariff barriers that may be on the table. Those are tough to negotiate. And in many cases, they'll take changes in home country laws because they deal with things like taxation. If you have a VAT, I'm not sure if Vietnam does or not. I mean, that's the big bugaboo with Europe, and the EU is the VAT tax. That requires changes in legislation and may be very difficult. So doing this on 90 days is going to be tough, but I think the administration, my expectation is we see some announcements around some countries Again, Japan, Korea, Vietnam seem to be on the short list. UK wouldn't surprise me, where you maybe even get a bilateral deal. I think that was already in the works before all of these announcements. And so you see some announcements, some deals there. And then you've already seen company level announcements, which I think are important, right? The $500 billion in Apple, the TSMC bringing manufacturing of semiconductors from Taiwan into Arizona.
Sure.
Honda moving, halting the building of a factory in Mexico and instead doing it in Indiana.
Sure.
The last week's announcement on NVIDIA, I think it was $500 billion. And those start racking up, and you can begin a concerted PR campaign around this, as well as a handful of countries. That looks to me like a potential off-ramp.
Sure.
Whether they pursue that strategy or not, I don't know, but that seems like it could be an off-ramp here.
Are there other off-ramps than what we've just walked through?
Yeah, I think there's at least one. And if I'm an investor out there, I'm keeping my eye on the courts. I hinted at this earlier, the IEEPA statute under which the administration justified Canada, Mexico, China in the first instance back in January, February, the manner in which they justified the 10% baseline and the country-specific reciprocal tariffs were all done through this IEEPA authority. And again, in IEEPA, there is no mention of the word tariff. And so there have been a couple lawsuits filed, one by a relatively conservative not-for-profit on behalf of a Florida business owner, another by the state of California. It'd be interesting to see if these will enjoin at some point in time. But the threshold question on both is, did the administration have the authority under IEEPA to invoke these tariffs in the first instance? Really curious question, because there was lots of cheering in the investor community a year and a half ago when Chevron got overruled. And the Chevron doctrine, you'll recall, granted agencies and administrations broad latitude when there was ambiguity in statutes. And the court said no. If the statute doesn't specifically say you can do X, then you cannot do X. And so this could be the first interesting post-Chevron test.
Sure.
That, again, ironically, a lot of conservatives and members of the Trump administration hailed when it was ruled on about a year and a half ago.
Sure.
This could be the first interesting post-Chevron test at play here. And if I'm an investor, I'm watching the courts and trying to understand whether or not all of these tariff actions maybe go away as a result of court action and an overruling of them.
Sure. And that's the one Band-Aid that could rip the tariff policy regime off in one pull.
Well, not the entire thing. I'll go back to the sectoral tariffs are on solid legal ground.
Sure.
So 25% steel, aluminum, and some of the other planned ones that are coming on pharma, semis, lumber, copper, those I think could stick and could be sticky and may be where this ultimately lands when everything shakes out.
Sounds good. So we'll be sure to keep an eye on the courts and how those cases develop. One of the big things with tariffs, obviously, is concerns about the economic impact. There's the direct economic impact in terms of trade. We're also seeing kind of second order impacts. We're seeing things like declining travel from foreigners to the U.S. I saw a report earlier last week that flights from Canada to the United States were down call it 50% year over year. Massive decline in tourism dollars coming to the U.S. Goldman Sachs had a report last week that estimates about an $85 billion hit to GDP this year due to declining foreign tourism in the U.S. And then you're also seeing consumers abroad kind of just walk with their wallets down the street, where they're boycotting kind of your foremost American brands in things like coffee and burgers and goods chains and things of that nature, where there's a good domestic alternative that they can go to. And so you're starting to see some of these second order impacts stack up as well. The one big economic stimulus impulse that we could have coming is tax relief.
Yeah.
And we'll pivot the conversation there. So we hear all the talk about one big beautiful bill. So Jason, what does that mean in terms of changes to the tax code? what's on the table and what'll be considered as part of it.
Yeah, quick level set here. The 2017 TCJA, Tax Cuts and Jobs Act, also known as the Trump tax cuts, expire, at least the individual portions, on December 31st of this year. And so there is a deadline, which Congress often needs, that's going to force action and conversation around taxes. There are differences of opinion among House Republicans and Senate Republicans on how you do that, how big an extension should be, and whether there should be consequent spending cuts to offset potential revenue losses from expanding tax relief. And that debate is fully enjoined. Right before Congress parted for its Easter recess, a week and a half ago, the House and Senate came to agreement on really a process bill in order to advance the debate. It wasn't easy getting there. The votes were nail biters, principally because the margins in the House and Senate are really thin.
Sure.
3 in the Senate, 2 in the House in terms of votes that the Republicans have to give up. And the real work around crafting a tax bill now begins in earnest, because what was passed a few weeks ago or a week and a half ago was a framework for this is the dollar value in spending cuts you need to achieve, and this is the dollar value in tax relief you can provide. That number on taxes, that's the important question here, the one you asked. Again, there's a difference between the House and the Senate. The House says $4.5 trillion. The Senate says, and by the way, that's what it costs effectively to extend current law. The Senate says, no, that you don't need to account for that cost. That's current policy. By merely extending them, you're not changing current policy, so that should have an effective cost of zero. Many call that a budget gimmick. And so we're going to extend current policy as part of our plan and add another $1.5 billion or trillion dollars. So the Senate could effectively go to 6. That has to be resolved.
Sure.
And it probably gets resolved. This question of this current policy baseline probably gets resolved by the Senate parliamentarian. But the bottom line number has to get resolved. And if the Senate wins the day here, then you extend current law of $4.5 trillion, which, by the way, probably isn't stimulative. And then you create space to add additional tax relief. And everybody's sort of on board of pushing the president's priorities around no tax on tips, no tax on overtime, no tax on Social Security benefits, which, by the way, is very difficult to do under this reconciliation process. You're technically not allowed to touch Social Security. Tax writers think they have a workaround. We'll see. But there's also a lot of impetus in folks that want to see SALT relief, state and local income tax reduction relief. There's members that want to see an expansion of the child tax credit. And so there's a lot of negotiation, a lot of interplay that needs to go on to figure out what the size and the scope of this tax bill is ultimately going to be. And my view is, now the Speaker of the House says he wants it done by Memorial Day. My view is that it's going to take much longer than that. And we're probably into the summer and maybe even the fall before we have resolution on size and scope.
Sure, which is obviously challenging again, because even though we have the announcement of the Innovation Accelerator and all these very sizable capital intensive investments that have been announced, real dollars aren't necessarily flowing on all of these projects yet. And that would have been some of the offset to the economic situation imposed by tariffs. And so pushing out the tax policy changes even further, probably would be a little bit more concerning from a slowdown, tepid growth perspective. And as we look to get the spending resolved, you're talking numbers in terms of 1.5 trillion in a gap that needs to be paid for. We're hearing Republicans talk about potentially even raising the highest marginal tax rate, something I haven't heard from Republicans in a long time. Ever. Yeah. And so how do we fill that gap?
Yeah, there's a number of things on the table. You mentioned one of them, which really emerged about 3 or 4 weeks ago and really surprised me, and that was increasing the top rate to 40% and for millionaires. Carried interest. And for those investors listening that have concerns around carried interest. That's very much on the table. It could likely get resolved, and my gut tells me it will probably get resolved much like it did in 2017, and that is an extension of the hold period. In 2017, it was from 1 to 3 years. Here, we could be looking at 3 to 5 or 3 to 7 years. Another big ticket item on the table is the institution of SALT for corporations. SALT on corporate income raises an estimated $200 billion. SALT on corporate property raises somewhere in the neighborhood of $400 billion. That's a big ticket item.
Sure.
And if you're a business owner listening, that's something that could have a direct effect on your net income. And so those are some things that are on the table and currently being debated. Other things are just straight up spending cuts. Things looking and some of these are required under the budget instructions, and it's looking at some of the entitlement programs. Medicaid is chief among them. Looking at SNAP benefits. And so there's a number of spending cuts that are on the table. And by the way, when you start introducing those, you start potentially also losing moderate Republican votes, and particularly in the House. And with a 2-vote margin in the House, the math here gets really complicated, which is why I think this is going to take a long time.
Yeah, I mean, it's kind of along the same theme of like we're walking a fine line here. When it comes to getting this bill done, when it comes to the ultimate economic impact of the tariff and trade policies, it's a really fine line. And something else that we have going on in the background, and this is one of those where maybe it's a little bit more noise, and it came up a little bit in the first term with Trump as well too, where Trump would kind of jawbone the Fed a little bit and kind of encourage lower benchmark rates. But this is something that's obviously very, very important for market stability, this concept of Fed independence. And, it is really kind of what separates a developed market economy from an emerging market economy. I heard some folks on the street last week talking about the U.S. behaving like an emerging market economy. I don't think that's necessarily the case to that extent just yet. There's a lot of very stable aspects of the institutions that we have. But Fed independence is exceptionally important. I think every politician would love to have borrowing costs as low as possible, the ability to spend as much as possible. But we see that doesn't fare well in the long term for nations. And so, the question of how much authority does the president have over the Fed chair? Can Trump fire Powell? How much can the jawboning actually have an impact? As opposed to being kind of noise in the background.
Yeah. So first, Powell's term ends May of next year, so a little over a year from now. His term as chair ends. His term as a governor is extended, I think, until 2028, but it's longer. But his term as chair ends next year, and he said he's staying. The president would have to proactively say, "Not on my watch. You've got to go." And there's a massive legal debate beginning to rage around whether or not he has the authority to do that, and whether or not a president has the authority to fire the head of an independent agency. The president has already dipped his toe into this a little bit. He last week fired 2 Democratic commissioners on the National Credit Union Administration, independent agency, with multiple members. He fired, a few weeks prior to that, Democratic members of the Federal Trade Commission, again, multi-member independent agency. And a few weeks around the same time, fired the Democratic board members of the FDIC, again, independent agency. And so there are some independent agency board members, commissioners, whatever their title happens to be, that have been fired by the Trump administration already this year. Court challenges may be enjoined on those, but in none of those cases has he fired a head. And there may be a question that ultimately turns on mere members of the Fed board versus its chair, and mere members of some of these other commissions versus its chair. And it's going to be interesting to watch to play out. 1935 Supreme Court decision, Humphrey's Executor versus the United States. The Supreme Court ruled that Franklin Roosevelt, who was trying to get rid of independent commissioners that he could not do that. And that is the case that will be tested here. And it'll be interesting to watch and see whether the court wants to try to thread the needle around a distinction between a member of a board or a commission and the head of a board or commission.
Sure.
And I think that's something to pay attention to and watch. Right now, it's not entirely clear to me that the president has the authority to get rid of Chairman Powell. But to your point, I'm not sure the conversation around that possibility is entirely helpful to the stability of markets.
Sure. And, the other thing to keep in mind, too, Powell does not set policy in a silo. The Federal Open Market Committee sets monetary policy. There's a larger membership than one person. That membership rotates every few years. So to be able to unilaterally kind of dictate monetary policy or get an intended outcome, if this is the intention, of the administration, this goes to the point of institutional stability.
Yeah, and the other question here is, could this be the line over which President Trump crosses that Republicans in the Senate say that's maybe a bridge too far? Senator Kennedy, member of the Banking Committee, yesterday on one of the Sunday shows, dug in pretty hard on the sanctity of Federal Reserve Board independence, and again, are there enough members there to push back? And that pushback, by the way, may take the form of, I'm not saying this is what's going to happen, but could be something along the lines of, Powell's got to go. Powell goes. Here's my new person, and we don't think they'll have enough independence, and so we don't confirm them.
Sure.
I mean, that's a scenario that could play out here. Again, doesn't really inure itself to market stability in the near term.
Sure, especially when you're going through a period where overseas investors are questioning demand for dollar-denominated assets a bit. You see some, institutions kind of hedging with additional gold exposure, if there were some active de-dollarization around the world to protect the value of their own central bank currencies. So, it will be interesting and very important for markets if that challenge to Fed independence continues to be something dominating the headlines. Again, something that's distracting to markets and not helpful. Ultimately, I think, we saw some of this in the first term, as I mentioned before, that kind of died down, went away. Would think that, based on your comments, that the hill to overcome on the part of the administration to truly pose a meaningful challenge to Fed independence would be a steep one.
My gut tells me, that's probably the case.
So, Jason, that's a really helpful perspective that you've shared, and you've been very generous with your time here. And I think, myself, all of our listeners are very grateful for that. We love having you on the podcast. As we think back over the episode, tariffs and trade, my big takeaway from you is watch the courts. What specifically do investors need to pay attention there as their key takeaway from that?
Yeah, I think the courts are, again, on tariffs. Watch this IEEPA authority. Does this get a hotline to the Supreme Court, and is Chevron and the ruling that they made last June stick? The courts could be very important in terms of the current decision around Humphrey's executor when we get to Fed independence. And as a guy who worked on Capitol Hill for a number of years, and I've said this on this podcast many times before. Congress still matters in some of these processes as well, and that's certainly going to be the case when we turn to the tax discussion.
Sure.
They will have to pass a law.
Sure.
And they will begin to matter in this process. And they can make determinations as to whether or not they want to involve themselves in the tariff debate, if they want to involve themselves in Fed independence. And so I still firmly believe, as a congressional institutionalist, that Congress matters in this process too.
And in the meantime, they'll be looking for ways to pay for it, right?
Exactly.
So, Jason, thanks again for coming on the podcast. Your years of experience in DC, accrue benefit to myself on the research side, but throughout the organization, and absolutely love having you on.
It's great to be here. Thanks so much.
Terrific.
Take care.
Thanks, Jason.
All right, bye-bye.
This episode was recorded at the FS Investments headquarters in Philadelphia's historic Navy Yard. It was produced by the investment research team, edited and engineered by Aaron Sherman, video produced by Melissa Venditti, copy provided by Harrison Beck. Special thanks to show coordinators Ellie Zhang and Laura Coleman. If you enjoyed this episode, be sure to like and subscribe wherever you get your podcasts. Thanks for listening.